Welcome, everyone. Looks like we've got Donald. I hear you've been speaking to Dean recently. Welcome. Nice to get you live. And if you have a microphone, we'd love to hear your voice and say hi. Ron, welcome. Ken, welcome.
Hello.
Jim. Joseph. Everybody, I've unmuted you while we get everyone loaded in here. I'm going to provide some immediate content while we wait for people to join. And then we'll get the show on the road. We've got a lot of people coming in. Unmuting everyone so you can say hi. We've got members, we've got people interested in joining, and everything in between. We've got staff on here. Welcome, everyone. Thanks for joining us live. Is my audio coming in smooth?
Yeah, Jason, sounds great, bud.
Excellent. Oscar, how's it going?
How's it going, Jason?
Going good, buddy. Going
You
good.
piqued my interest.
Yeah, oh, I teased you. Yeah, well, I made the slides, so your time won't be wasted. I got two outcomes, two parallel universes, what might a couple of months here, and how that would affect our portfolio. Let me just throw a shout out to some new names in here. And we're now over 155 members, so I don't know everyone by name now. Only if you've been chatting with me, I've gotten to really get to know you very well. So John and Oscar, very familiar with. I think Joseph's a member. We got NM Usani in here. SBG Trading Corp, I believe he's a member. Tom Lauer, I'm not sure if you've joined yet. Welcome. Ronald Brooks, he's a member. Heldreth, welcome. So thank you everybody for joining us. Oscar, since I got you live, would you mind? There's been no bribe to Oscar. What's your product so far?
I'm sorry, Jason. I hardly heard you.
Oh, if you could just give everybody a quick review of the program so far, what your experience has been.
Oh, my experience has been nothing but positive. I mean, this is a very conservative but effective way of transacting your portfolio, and I got tired of managing a portfolio. I got into this my father-in-law was trading constantly, and he asked me what I thought of this, and I signed him up, and unfortunately he's suffering from Alzheimer's, so I kept with the program for him. I signed up myself, and I've been very impressed. You're very knowledgeable. The methodology and the thought process behind it makes absolute sense. Very limited risk. Basically, you're not going to look at the market performance, but you're going to deliver 1% a month, and that's not assured. Nothing's assured in this world, but that's pretty constant. And it piqued my interest, and I've been impressed ever since.
Thank you, Oscar. I really appreciate that.
And Oscar, let me ask you, do you have more or less than $500,000 behind this total now?
I've got roughly $1 million.
Okay. Nice.
I mean, what I've been doing is I've had positions that I've had for a long, long time. And as some of them get called away, because I've always sold covered calls on them, I don't bother replacing them. I just buy the SPY and follow Jason's recommendation.
Nice. Yeah, you have some chat box. Ron says hi. Thanks, Ron. How are you doing so far? All right, guys, I'm going to do a quick little presentation, and then I'll open it back up for dialogue. And so I'm going to mute a few people here just so we don't have a lot of feedback. And I kind of teased some of our paid members who had a webinar yesterday with us to join the freebie webinar with some new content I haven't released yet. So hopefully everybody enjoys it today. And really, we're going to look at kind of two parallel universes, what I think might happen going into the future. And so, see, Dean, you should have audio at all times. So if you want to perk in at any time, go ahead. We now have 17 people live. Thank you, everybody. We got a few people joining in. Elizabeth Davidson, Malcolm Waters. The goal of this webinar is going to teach you everything you need to know to accurately follow our program, and then some. I'm going to also teach you the methodology so you get a feel for how our strategy works and what might make it not work. Today we had a great return. We were down 0.4% yesterday, and predicted that let me mute a few other mics that are just getting some sounds in there. Everybody knew the Fed was going to cut 25 basis points yesterday. That is no big surprise. But being able to predict how that would affect the markets, our portfolio did very well with. And so we had a record profit from yesterday through today. And again, this is on a $1.4 million portfolio. So we're not trying to brag about $10,000 based on a small trading account. Our product does seem to attract more of a conservative base with a larger portfolio size, but I will show you how you can follow with as little as $75,000. And with that said, I still think you're better off, whether you want to be conservative or not. You're probably going to be a lot better off following our program in the long run than just about anything else out there if you're trying to just buy and hold and feel lucky with the markets. So let me just do a quick little overview of what we do, and then we'll jump into sort of what I am predicting will happen and how we're going to play those markets and what that translates into in terms of trade alerts. So again, our program is based on daily income trade alerts that are delivered at noon Eastern, Monday through Friday. You get the content sent to you via email, text message, plus I go live on YouTube so you can chat with me. If you've heard me chatting with people like Oscar in our live stream each day and the recordings, well, that's how. You can click that link and ask me questions about the trade alert. Now, so far I've had 0 questions about the trade alerts. That's how easy this is to follow. Our goal is not to outperform the S&P 500 or any other advisory out there. A lot of people ask me which subscription services I follow. None, absolutely none. Now in our bootcamp, you'll see I do consume probably about 8 to 12 hours of content a day. And at the end of the day, I'm just trying to predict really 2 major markets, and that's the S&P 500 and the long end of the Treasury market. And so we're very slow moving in terms of changing our forecast. And so that results in very repetitive trades. And, I've had members hop on and say, well, the trades are super easy to follow. They're getting the same results we are. They're not getting rich overnight, but they're having very little drawdown, and they have fun trying to predict which strikes we're going to pick each day. So you have a pretty good idea of what my thoughts are, why my thoughts are in such a fashion, and you'll see that our ability to change to market conditions happens very, very slowly, as these things don't happen overnight. So our goal is to generate a 1% return per month, no matter what the market conditions are. And even more important than delivering a 1% return is protection of capital. So I would much rather play it safe than take on extra risk hoping something might happen. So you can see in December when the S&P 500 crashed way over 15%, our portfolio had a 1% return. That's because our SPY put options kicked in and the TLT shot up. So you'll see almost always, because of the way we've designed our trading strategy, that's even if we don't predict a market crash is going to come, that's usually what happens. Our put options kick in and the TLT delivers a return. So you can see in December, we did generate a 1% return. But in February, who would have known that stock crash would have stopped? Sure, you could have been betting on a plunge protection team coming in there to rescue the day. But we certainly didn't know that was going to happen. In January, we underperformed the S&P 500 and had a 2.2% return. And again, we're not trying to beat the S&P 500. even though the SPY does typically represent, at a minimum, 40% of our total portfolio. In fact, our goal is to take these two key markets and tame them down considerably for retirement income and protecting capital. February, March, we had a 1.7, 2.7% return. April, 1.2. In May, there really wasn't any good reason for this sell-off except profit taking, perhaps. I don't think anyone really saw that coming. I certainly didn't, but our strategy worked. We walked away with a 2.2% return. In June, I thought this was overdone. We did take on a little extra risk than normal. Kind of took the training wheels off the old bicycle that month. We had a 3.2% return, our best return to date. But of course, that's nowhere near the 8% return the S&P 500 delivered. In July, I was very concerned that the US-China trade deal would break down. If it had, there's probably a minimum of a 5% sell-off in the books in July for US equities. And unfortunately, they came across with a trade deal. Kind of sounds familiar, doesn't it? Well, the trade deal immediately gave the July stock market a little bit of a bounce, and we were positioned a little overly bearish at that time. We lost 1%. This is our only losing month in the past 11 months. And lo and behold, completely caught off guard. Trump raises the tariffs in August. The same setup happens. The put option kicked in on our SPY, and the TLT shot up in value, delivered a 1.8% return, while the S&P 500 delivered a -7. Now you could say, well, look, the S&P 500 is outperforming your returns. But what happens the day the market doesn't have this miraculous recovery? What happens when it has a 30, 50, even worse crash? That's what you really got to think about. So what's more important than our ability to generate 1% return is our ability to do so with very, very little drawdown in any single month. Our biggest return, or rather loss, is only 1%. And that's what's so much more important about our strategy than anything else. Now, October, it looks like we're going to sneak out with a 0.3% return, just like in September. And once again, the TLT is paving the way for the majority of those profits, although we did catch some nice profits on the SPY over the past month. Here's the current setup of how to follow our program. You trade the SPY Monday, Wednesday, Friday at noon Eastern. The emerging markets ETF currently is our pick for Tuesday. The TLT is traded on Thursday with 200 shares. And then we're having a buy and hold position in GDX. That's the gold miners. We've played gold for most of the year, spot gold, and have recently rotated into the miners. Now, this is a position that gives us 50% risk in equities, 40% in bonds, and 10% in gold. But I want to point out that we are using option callers on the SPY, emerging markets, and TLT that can protect downside risks and also help us generate profits, predicting any of these assets will go down in value. And we'll take a look at how we can cleverly use the options market to do so. The GDX position, we have no training wheels on, no bumpers. We're just letting that ride right now. And in our presentation in a minute, you'll see why. Now, if you do want to follow the program with less money and less work, you can get the same risk profile, trading 50% equities, 40% bonds, 10% gold with emerging markets TLT. So you'd have 400 in the emerging markets ETF and then 100 in the TLT. Gives you the same setup, 130 in GDX. You're not going to have the same safety as the SPY, which trades 3 times a week, but you will potentially have a greater return with less work. Expect more volatility in this setup. So why would you think about doing this? Well, our 4 ETF portfolio is extremely diversified. The SPY has 500 companies. Emerging markets ETF has 1,000. So if you're worried about not owning enough companies and spreading out your risk, well, then this is probably actually safer than what you're doing right now. Our goal is income and safety, not growth or speculation. This strategy allows you to simplify your holdings reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Okay, I'll skip any promotional stuff. Here's a quick disclaimer. What I want to do now is jump into, in a moment, we're going to go through part of our bootcamp presentation. This is a $10,000 program. We're going to preview some of that content today for free to give you an idea of how the strategy works. And we're also going to look at some of the trade alerts. So I think what I'll do is go through a handful of trade alerts so you can see just how easy it is to follow the trades. And then I'm going to try to give you some background in terms of why these ETFs, why this strategy, and what does the future look like? Can we just buy and hold stocks for the rest of our life and then through retirement and continue the same results we've had over the last decade? Or are things getting riskier than we think? So we'll take a look at that in a moment. All right, so I'm going to go back in time and just show you the last 4 days of trade alerts so you get a feel for what they look like. Now, you guys have been receiving them, but we're just going to overview it. So right at noon Eastern, you're going to get an email and a text message with a link. So the image will always link to the live stream video. That's where you can listen to me for about 30 to 60 minutes, talk about the most topical news that's affecting our trading decisions and review the auditing for how profitable our previous trading period was. So on the 28th, we were trading the SPY, and you'll see I do the accounting for you. We're going to look at when we entered the option contract, what was the SPY trading at? In this case, it was trading at 302. And then we look at when we exited the option contract. And in this case, it went up $1.12. Now, the option caller, designed to protect the position, brought in a credit of 12 cents entering the trade in this case, but we had to pay 43-cent debit to exit. So we had a net loss on the option caller of 31 cents. And so what I do is then calculate the profit per share after we net that out. After that, you'll get a summary of the key macro points. Now, this is going to be covered in more detail in the video, so I do highly recommend watching the video every day. After that, we review our returns and our monthly breakdown. So you can see just a few days ago, we were sitting at a negative 0.4% return. And this was once again because we were positioning for a breakdown in the trade talks. Surprise, surprise, they're going to do a farm deal. Now that farm deal gets weaker by the day. So we'll see if it really comes off. And after that, we review your trade allocation. Very rarely does this change, but sometimes it does. After that, the trade alert, we have this breakdown of the returns per month, so you get a feel for what to expect in the past. This is what we send out via text message. A lot of our members take these trades on the go from their phone. So I've heard of members doing these trades with 7-figure portfolios from restaurants, from airplanes, in their car, all over the place. Now, a lot of people do like to go to their desktop so they can read the full email and see all the charts. That's what I would recommend. But for those of you who are on the go a lot, realize this is so easy to do. You can get the text message and punch it in on your phone if you simply download a phone app. So if you're using Ameritrade, that's our ideal broker, free commissions, and they have a great phone app that can process these trades in literally a couple clicks. Next thing I'm going to do is show you how to exit the previous trade with a screenshot showing you exactly how to fill it out. This will be almost identical in all trading platforms. Certainly the terminology will be the same. After that, we show you the new trade alert visually so you can see how to fill it out. This is rolling over the position. And then finally, we give you the risk graph. This is going to show you the maximum gain or loss for this trade setup. Now, we never touch these trades outside of the planned dates. This makes the program passive and easy to follow. I call it atomic bomb proof. Now, think about it. If you're going to have to be rushing to your computer to take emergency trade alerts, it's not going to be a very passive, relaxing trading strategy for retirement, now is it? So we give up a lot of profits by having this extra layer of protection. And typically we will sell a put option, or rather sell a call option above the trading price. In this example, we were selling the 304 call, and then we're buying a put option. So we're giving up upside potential by selling a call option, and then we're typically using that credit to finance our insurance to the downside. So we always have a put option right below each asset, protecting us against any kind of nightmare scenario that could cause significant losses. Now again, we're always having these put options on the TLT, SPY, and emerging markets, but we're not using this very often in the gold portion of our portfolio. And we'll take a look at why in a moment. So that was the trade from the 28th, which was this Monday. So this would be then not touched until Wednesday. The following day is our emerging market play. It's going to run almost identical in terms of content. In this trade alert, we're going to show you what happened from the previous Tuesday to the current Tuesday. Once again, we're going to compare the price change of the underlying asset, calculate your profit or loss, and you're going to see the change in price of our option caller. Now, from a marketing standpoint, this accounting method and visibility and transparency in our advisory makes it very easy for me to sell the program when we're winning. But the catch is when we're having a period of drawdown, it does the exact opposite. Now you'll see, and I'm sure you have seen, that we don't hide the losses. We report the return like clockwork, whether it's good or bad. So I hope you do notice that, and gives you more faith in our credibility and honesty in the returns. Next, we go into the key news. This is again a summary of what's covered in the video. It can't get close to the amount of content I can speak in about 30 to 60 minutes. So once again, don't skip the video. It's always unique content, even though it starts off reviewing the trade doc. Now, from time to time, I will break out the return that you can see per portfolio, just to point out how a certain portfolio is doing. Keep in mind, at any time, you can click on the track record link and go to our track record. This has a breakdown of each strategy at all times, so you can see how each portfolio returns, and you can click the tabs below and see every trade that's ever been placed. So we have our equity trades right here. If you scroll over, we have our option writing in pink, and then you scroll over further and you'll see our long options. This is primarily our insurance, buying put options, and this is primarily us selling call options for income or to finance our insurance. So you have all these tabs below, which just makes it very easy to track the results of each strategy, even though they are designed to be overlapped together. So once again, you get your allocation, you get your trade alert text message summary, you get the screenshot. It's very, very repetitive, very predictable. And in a moment, you're going to see why it works so well. Okay, now we go to the next trade. Here is the Wednesday trade. This is the day we trade the SPY. So now we're going to close the previous Monday's trade and roll it into the new position. Okay, so once again, you can see the SPY lost 43 cents, but the option caller did its trick, protected the position. We only lost 11 cents. You get a summary, key macro, breakdown of returns month by month. You get your trade allocation. Scroll down, we get the text message that's sent to you. We show you how to close out the previous trade and how to roll it over to the next trade. Very simple, very repetitive, very easy to follow. Which brings us to today's trade. Today's trade, we review what the TLT did. It's Thursday, so we're looking at where the TLT traded in the previous alert, the last Thursday, and we can see the results. I summarize this all out for you. Now, you're going to get very, very close to these returns because I'm taking the screenshot at 11:30 Eastern, and you're getting it by noon. So there's only a 30-minute time discrepancy from when I'm entering the trade and when you can get the trade alert to follow. Summary of the results, key macro, we scroll down, we get the trade alert text message right here. I'm going to show you how to close out the previous position and then how to roll it over into the new position, followed by the risk graph. Okay, it's very repetitive. What is the strategy? How does it work? Let's take a look. So what I'm going to do in this presentation is show you our basic methodology and then give you two potential outcomes for what I see possibly happening in the upcoming years. The easy way to predict markets and generate safe income. Okay, so you guys have seen this a million times. I'll skip through that. So there's really three key things that I'm trying to predict. Number one is if the Fed is buying or selling treasuries or on hold. And more importantly, what are they going to do in the near future? So we've been expecting that the Fed would buy treasuries, and they have been. As of the last 2 months, they have purchased $200 billion of treasuries, which is not that much, but now they've committed to $60 billion a month. So you add that plus the 200, we're looking at $800 billion of treasuries coming out of the bond market, kind of getting swept under the rug into the Fed's balance sheet just in the next 12 months. The next thing I want to know is the Federal Reserve raising or lowering interest rates. And this is going to play a huge role on the TLT and subsequently in the equities market. So if we know if the Fed is buying or selling treasuries, that's going to have a large impact on the bond market. And then if we know if they're raising or lowering interest rates, that will also have a huge impact on the bond market. The third thing I'm really concerned about is the inflation rate. Now, the inflation rate is definitely subdued to the downside to allow the Fed to continue this current policy of being very accommodative to the banks. But as you'll see, in history, from time to time, inflation gets out of control, and that breaks the financial system. And it also breaks this long bond, long stock strategy that has done so well for our portfolio in the last 11 months. And so what we're looking out for is the bubble to pop. And we have two clear bubbles we need to be concerned about. We have the S&P 500, which is now up some 450% from the last crisis. And we have an even larger bubble in the bond market. And that is now at $266 trillion in value with $16 trillion at a negative interest rate. So the people who've bought these negative interest rate bonds have a guaranteed loss every single year, which is absolute insanity. And that's just in the sovereign debt. And so here are the two potential playouts of what I think will happen and how our portfolio will adjust. And in a moment, we'll look at the relationship of the SPY to the TLT so you can see how those two can protect one another when we have low inflation. Okay, so here's what I think may happen and how we will play the markets if there's no trade war and this impeachment kind of blows over. This is basically a position where we have low interest rates that are headed lower. We have low inflation, currently at 1.7 is the most recent print. And we have a Fed who is clearly adding money to the financial system. They're doing it at a rate of $60 billion a month. And they have this now overnight lending that's at a $200 billion level. And that's been growing over the last 4 weeks if you've been following this whole repo madness. So this is the conditions for a general bubble up scenario. We're long the SPY, we're long the TLT, we're long gold, and we're long emerging markets. My expectation is that this sort of condition could last for up to another 2 years. And to back that up, I'm just looking at the current federal funds rate, which is at 1.5 to 1.75. If they were to slowly but gradually lower interest rates at a rate of 25 basis points every 3 months, that would give us 7 quarters or just under 2 years to get to what I would suspect is the lowest rate the Fed would go, 0%. Now, why would they keep lowering rates? That's because of the global slowdown and the crashing GDP of China. So we'll may not have time to cover all of that in today's webinar, but that's why the rates are going lower. And this scenario works very well as long as inflation stays low. Now, in a moment, we're going to look at the alternative path where we do have a trade war escalating and impeachment gets ugly, which very well may be the situation we're headed into in the next several weeks, maybe even months. So what happens eventually when you lower rates to zero and add trillions of dollars? Well, as you're going to see in this presentation, you almost always end up with inflation. So what happens when you get inflation fears? You get a bond market pop. So this is a scenario where the bond bubble pops first, and we get a final hurrah in the stock market and in the gold and precious metals markets. So in this setup, we would trade out emerging markets for a potential higher return in silver. And we would begin to use our option callers to profit from the TLT selling off. Now, in a moment, we'll show you how simple it is to optimize your option callers and still own the TLT, but profit to the downside safely. Now, what happens when bond yields get too high? Well, all of a sudden, it makes no sense to own stocks at all-time highs. And if this scenario plays out, stocks will be much higher than they are currently. And you got to ask yourself, do I want a 3.5% 30-year treasury? Or do I want to buy stocks at maybe 3,300? And the quick answer is just think about 2018 when the 10-year treasury hit 3%. All the money flooded out of the stocks and grabbed that nearly guaranteed profit from the US Treasury. So this would potentially happen from 2021 to 2022, where the money would flood out of stocks at all-time highs and into the bond and precious metals markets. What happens next? Now you get your rising interest rates. Once again, we have inflation coming because of too much quantitative easing. All the money has just dumped out of the stock market. It's flooding into the real economy. Now we have a period where the Federal Reserve has to raise interest rates. Think of 1965 through 1980. Paul Volcker, you guys lived through that period, the Cold War. This is where interest rates got as high as 20%. And this is the exact opposite of what we're in right now. This is what Ray Dalio's predicting. He's saying we're in the 7th or 8th inning of the melt up before the big meltdown. And this is a period where we wouldn't want to own anything except dollars, and we'd actually be short the equities market and the bond market. So if we get rising interest rates with no quantitative easing, that's your nightmare scenario that most investors are completely unprepared for. And then finally, you get your reset. This is your Warren Buffett's sort of environment. We would enter a period where rates have already been jacked up very high to fight off inflation. Quantitative easing had stopped to also fight off inflation and malinvestment. And now we have the expectation of lowering interest rates and potentially future quantitative easing. And so this would be after a stock and bond reset, both have collapsed and are now in a period of reset. In this portfolio, we would amp up the risk slightly and have this portfolio right here where we're long the QQQ instead of the SPY, we're long emerging markets. Instead of the TLT, we'll go with the investment grade corporate bond fund, and our buy and hold switches over to Apple. But what happens if we have a trade war with China that gets out of control, and who knows, maybe an impeachment? Well, we're in the same environment, and this could be happening in the next 4 weeks or less, unfortunately, where we have low rates, and in fact, expectation of rates going far lower if we have a trade war. We still have low inflation. We have quantitative easing. If you add fear to the mix, what may happen? Well, we've seen the stock market is extremely sensitive to trade war headlines and now even potentially to impeachment headlines, especially with the fear that someone like Elizabeth Warren may take the Democratic nominee. So in this situation, we still have the same assets. We're going to use the option caller to protect the downside and actually profit from the downside. If this outcome comes, our TLT and gold position is going to have a heyday, and we're going to want to be short equities. Now, I say that with a caveat because it's short-term short equities. I don't really want to be short equities long-term until the credit market really cracks. So what happens next? Once again, rising inflation. We're still doing quantitative easing because we're in the middle of a trade war. We're having political chaos. We're leading up to, this could potentially be after the election. And this will send gold market higher. And this should be saying pops up. My apologies on that. This would be the situation where we have to face Federal Reserve raising interest rates and beginning to end quantitative easing in a period of fear. So with raising rates and fear in the market at the same time, we're going to be short the stock and bonds, and you get your final hurrah in gold and silver. After that, you get your rising rates, probably the next recession or depression. And then finally, you're back to reset mode, Warren Buffett strategy once again. So at the end of the day, really what's going to ruin the party for us is rising inflation, causing the Federal Reserve to raise interest rates. And we'll take a look at that in a moment. Let's take a look really quickly at how we can take these different assets and profit from different conditions. So if we think the underlying asset's going to travel higher, we can simply sell a call option above the trading price and buy a put option below. And this is what we call a bullish loose option caller. This is the trade we have on the TLT right now because we think there is a greater risk of fear in the market driving bonds higher. So not only do we have the Fed in a phase of lowering interest rates and taking pressure off the bond market, there's a lot of risks right ahead of us, namely the trade war and now this fear of impeachment. Now, here's the setup we currently have on the SPY that's allowed us to jump into a profit today. We have a tight option caller. Now, you can see in this setup, we actually profit if the SPY goes down a little bit or flat. We're not betting down. We're just not really betting up. And so we're selling an at-the-money call for a huge credit. You can see in this case $1.53, and then we're buying downside protection with a put. So we're simply reducing the spread between where the call is written and where the put option is bought. So you can see the spread between those two is $2 on this example, and in this example it was $6. And you can see in one scenario, we have the potential to win $310 per contract or lose $290. And in this case, we've reduced that potential win or loss down to $100. So what happened today? Well, yesterday we locked in those high rates on the SPY with a tight option caller, and we had a sell-off this morning, causing the TLT to pop up and our put option to kick in on the SPY. Now, here's the last setup you need to know. And this is what we may be facing if the trade war really does amp up or the impeachment fears become more intense. And so this is where we actually sell the call option below the trading price and we buy the put option above the trading price. So you can see I'm taking a huge credit of $2.19 in this example to sell an in-the-money call. And then I'm reinvesting it into a in-the-money put. So this setup profits if the SPY travels lower. So once again, the put option generates a greater profit than you're losing on the underlying asset. So if the market goes lower with this setup, in terms of the SPY, the call option increases in value and the put option increases in value. Now, we'd love to put these trades on, but you got to remember the entire financial system is engineered to gradually grow in value in terms of bond yields going lower and bond prices traveling higher and equities traveling higher as well. And when that doesn't happen, you get financial crises. So here's our 3 setups to review once again. You will not see a trade setup that is different than these 3. This allows us to trade the same assets week over week over week, and by slightly adjusting the options, generate profits in different market conditions. So here's your loose option caller. Here's your tight option caller. And then here's your bearish inverted option caller. Now, if this seems kind of like Chinese to you, don't worry. We do have a boot camp that will make you an absolute pro at understanding all of this lingo. And for a lot of you, this is probably pretty easy already. So how does the strategy work and when does it break down? So what we have here is the SPY and the TLT. Up above is the SPY and down below is the TLT. And what's important to note, just from a visual, is notice the sharp drops in the S&P 500 and underneath it directly the rapid rises in the TLT. So there is a harmony between the bond market and the stock market where one sells off and the other rallies. And so you can see over the period of time, both have traveled higher. Here's a look at the TLT all on its own. And just look, there's tremendous spikes in value in the TLT during times of trouble. So we have the 2008 crisis. We have the 2011 flash crash. We have the slowdown in China in 2015. And then we have the 2018 period where the world tried to raise interest rates and clean up their balance sheets, and 98% of all assets crashed. So you can see that has driven the TLT to new highs. Here's a closer example. You can see in this example, the TLT rose 40% during the 2008 crisis, while the SPY crashed 50%. If you were just blindly owning half and half, you would have had no loss. Now in our strategy, keep in mind, we have put options on top of that. So as the SPY tanks, we're cutting off the losses and able to generate profits in these sort of market conditions. Here's another example from 2010 through 2012. And I just want you to see visually when the TLT pops up, equities are pulling back and vice versa. Together, they both went up in value over this period of time. 2013 through 2015, the SPY generated a 51% return, but your TLT position didn't hold you back. It only lost 2%. So it offered all of that protection against any risks in the market without really hurting your return. And then here we go. This is the most recent sell-off leading into 2018. Fed was tightening, doing quantitative tightening. We finally got the stocks to sell off and the bonds to save the day. Now, when do we like to own gold in our portfolio? There's really 3 factors. We want to see the Fed is lowering rates, check. Buying treasuries, check. Last magic ingredient is fear. And right now, we've done well because of the trade war, creating fear all year, dramatically rising the value of gold. And I think there's more fear to come. So we remain long gold because we do have those 2 core elements in place. Now, you can also note that when you don't have those elements in place, the value of gold falls dramatically. That's because gold doesn't generate income or profits. It's really just an insurance policy against bad monetary policy. Also, gold does provide some extra diversification that is uncorrelated to the TLT or the SPY. By layering all these together, it makes it very hard to lose in any period of time. Now, we like gold miners right now over spot gold. Spot gold's above 1,500. That means the miners can generate substantial profits. I'm going to skip through what's in the SPY ETF. I think we all know what's in that. Emerging markets ETF, just to point out, has 2 of the top 10 companies in the world, Alibaba and Tencent, Chinese companies. It also has the Taiwan Semiconductor, Samsung. It's got 1,000 companies in it. So I'll skip through that a little bit. This is a presentation on some of the advantages China does have in terms of investing in it in the long run. And again, we're only using a small part of our portfolio to follow that. There's a look at what's inside GDX. What I want to do now is take a look at when does our strategy break down in terms of being long stocks and bonds. And we did just kind of look at what outcomes may occur to cause changes in our strategy and how we would use those option callers to profit from those different circumstances. But the bottom line is when the Fed raises interest rates and stops quantitative easing, that can be very problematic for markets. And usually that's caused by either inflation or deflation. And so we can look at a few periods in time on the Dow where inflation caused some major hiccups in the market. So Ray Dalio likes to point out the period, the Great Depression before World War II, between World War I. Then we can look at the period of 1965 through 1980, and that's where we had the Great Inflation. And so during this period of time, you had a 15-year bear market. Now, a lot of people have forgot that period of time. They're looking at the dot-com bubble and the 2008 bubble, and they can tell themselves, well, even if we have a stock crash, maybe it's worth holding in case we don't, and because I don't want to realize the taxes that I've had on my appreciation over the last decade. But if you listen to Ray Dalio, he likes to look at 2 market cycles. We have the 10-year cycle, and then we have the 50-year cycle. And his indication is that we are headed into the 50-year cycle that's going to be much closer to this period of time. And that's because of extreme debt around the world. $266 trillion in sovereign debt, $16 trillion in negative yielding debt. It has to be worked down. So what's all this inflation about? This is a scary part of the presentation. You're going to see that there is clear inflation right now, and the Fed should already be jacking up interest rates, but they're not. So now we're at the whim of this almost comical horse and pony show we get every couple months where the Fed goes up, tells us what they're going to do. We have almost a fake media that goes and throws softball questions at them. And that's that. We live with it. So what is this CPI? This is how they track inflation. And you can see it does have housing and medical in there, but they've been dramatically reducing that sector of the inflation. Here's a look at the annual inflation rate. And the current trend is a downtrend. We're in a low inflation period. And this has been allowing the Federal Reserve and all central banks to go into massive debt. The governments are creating much bigger budgets than they can raise from taxes. So to fill in the gap, they print money. Eventually, that causes inflation. And those periods of inflation are what have wrecked retirement accounts over the past 100 years, time and time again. And so you can see these spikes in inflation, the Great Recession, the Great Moderation. Going back to the 70s, we had a long period of inflation. And this doesn't even get back to World War I period. So what does the Federal Reserve do when they start to see inflation? In the red line, we can see the effective federal funds rate. And in the blue line, we can see the inflation, at least that the government's reporting with their calculation. It's very simple. The second they see inflation starting to perk up and accelerate to the upside, they jacked the interest rates up quickly to push inflation back down. And so you can see, especially during this period of the 70s and 80s, the federal funds rate got all the way up to 20%. It wasn't until Alan Greenspan came in here in the 80s and spent the next several decades lowering interest rates that we had a significant long-term bull market. So a lot of people want to compare this period of time to the 1990s and say we've got a whole nother decade of good times ahead. So what happens when they jack the rates up? Well, you get your few rare GDP prints. It makes sense. If we're generating most of our GDP through credit and you cut off the line of credit, well, you're not going to show a profit. So that all makes sense. Also, we can see our treasury rates are magnetized towards the federal fund rate. So if we can predict what the federal fund rate will be into the future, we can know whether to be long or short the TLT. So at this point in time, we're not at risk of inflation, and there's a lot of fear in the market. So our prediction is the TLT will travel higher. But is there really no inflation? Give me a break. We all know there's been massive inflation. They've just been changing the formula to keep it artificially lower. A lot of people don't know the Federal Reserve is owned by private banks. Funny how that works. So what's gone up the most inflation-wise? Well, it's everything the government has subsidized and guaranteed to the banks, namely the housing market, the medical market, and then college education. All three of those have been subsidized by the government, and in turn, the businesses related to that jacked up their prices, and banks were happy to lend out money knowing they could not lose. So now we kind of have a feel for why there's protests all around the world. Your average Joe's income has remained relatively flat, but three of their biggest expenses have skyrocketed up. They're not happy. Here's another chart showing just how outrageous college costs have gotten, as well as medical. And even though they're just saying they want 2% a year, that really adds up. Here's the cumulative effect of the CPI. And that's with what they're reporting. Now, if we were to take the formula they used in 1990, we'd be currently sitting at a 5% inflation rate. That means the federal funds rate should be more like 6% right now, instead of 1.5 to 1.75. If we go back another decade, it's much worse. We're looking at 10% inflation, and it's not just sitting there, it's in an uptrend. So we need a Paul Volcker to come in here and get all this bad debt out of the market, get all these zombie corporations who are just borrowing at 0% and printing massive losses the heck out of here. We need a big reset to really clean up the economy. But the problem is nobody wants to live through that pain, so they kick the can down the road and get away with this as long as they possibly can. You certainly don't see Trump saying, let's raise interest rates now, do we? And so we are now at a point where we have record low unemployment. And if you listen to all the businesses, their biggest fear is that they're going to have to start paying people more money because they can't find enough good workers. Guess what that's going to cause? Inflation. And so we can go back through time and see that inflation is clearly what ruins the party every single time. We can see inflation during World War I, followed by deflation. They had no clue how to deal with this back in that period of time. This ended up with the Great Depression. And it's interesting, after World War I, everybody was so mad at those Germans that they wanted reparations. America got filthy rich from this. Everybody had to give us their gold in order for us to lend them money and food and eventually troops. And after the war, they could not stop arguing about how much money Germany was going to pay back to everyone, to the point that they caused hyperinflation in Germany, bankrupt the country. They did everything under the sun to try to avoid it, including changing currencies. It's quite a story. And this is where we had our roaring 20s, followed by the Great Depression and a massive stock crash. Now, that's not your 50% stock crash now, is it? That's your 90% stock crash. What's another period of time this sounds, and also, think about China. They have a situation where their GDP has crashed in the last decade from 30% down to 14% 5 years ago, down to 6% today. What's going to happen if the world really puts sanctions on China, cuts them off of capital, stops doing business with them? Is it going to be another repeat? Is it going to be like Germany going bankrupt? Perhaps. Another period of time that seems awfully close to this situation is the Cold War. Started in the 40s. This was also during a period of time after World War II where we were handing out freebies in the government. And it worked for a while. We had a great stock market during 45 through 65, but check it out, very low inflation. Sure, we had a 7.7 print in 48, but other than that, very stable levels of inflation. This let the Fed do what it wants with money and rates. And then eventually the inflation came roaring in. And look at that, from 1966 to 1982, inflation was above 2% and as high as 13. So what do you get? Well, during a period of low inflation, you get a gravy train. During a period of high inflation, you get a 15-year bear market. Now, sure, there's a bunch of jumps to the upside, and you'll see that coincides with Paul Volcker trying to drop his rates down, but inflation came right back. It was like cancer. He could not get it away no matter how many chemo treatments. So look at it. Every time he jacks that rate up, he got inflation down, but at what cost? You had all these recessions and stock market crashes. Eventually, he did kill inflation, but it took a massive amount of raising interest rates to 20% to accomplish that. And then what happened? Well, with 20% rates, you're not going to have zombie corporations running around losing money. Oh, no. You're going to have smart businesses that generate profits. And so we entered a period of easing with Alan Greenspan. What happened to inflation? It steadily declined. And there's a few hiccups through this period of time. But all in all, you had one of the biggest stock market rallies in history, which a lot of you folks probably benefited from. And here's what happened to rates during that period. Now, sure, there were some problems. There were some periods of raising interest rates, but in general, he gradually but surely got those rates much lower. And now the world has become hypersensitive to changes in rates. 2000, inflation barely hit 3.4 and we get the dot-com bubble. That was a 18-month stock market crash. 2008, we hit 3.8 once again. You get the financial crisis and the housing bubble. And you might think that's a normal stock crash now, but you got to remember, once we get to zero on the interest rates and we start to see inflation, it can last much longer than a year or a year and a half. It can last decades. And so what's been the policy of the last 2 decades? Well, they keep trying to raise interest rates, but every time they do, we get a massive financial crisis. And so we're coming to the end of this game of low rates and low inflation. Most likely, what comes next eventually is a period of inflation. And they're going to have to keep rates high, and this will be negative on your stocks and your bonds. So right now, we're sitting at a 1.8 print. Highest we've seen in the last 10 years was 3.2 in 2011. And so Powell says he won't raise rates until inflation is symmetrically above 2%. So he actually wants to make up for all the years we've been below and shoot it hot. Will he overshoot? So what do we do to make our market forecast? No, we're not following other advisories. Here's some resources I recommend. Then I'm going to jump to answering questions, talking to you folks. Might put up some polls here and see who wants to join us in the real program. So I recommend you get Ameritrade, free commissions, great support. They cover everything. Their phone app is remarkably easy to use. If you do join our boot camp, I highly recommend you get the YouTube phone app. We're going to be giving you a playlist of videos to watch each day and the channels I follow. In terms of what media to follow, we recommend watching CNN, Fox, and CNBC. I like to get a diverse perspective from multiple angles. Twitter, there's a handful of people I follow. Now I change this based on where the biggest risks are. And again, rather than trying to worry about where the next big win is, I'm much more concerned about where's the next big earthquake. What's going to cause losses? Here's the current setup I'm following. And I like to keep this feed as small as possible. Again, there's just too much to follow. Bloomberg's a great phone app. What I like to use Bloomberg for is to follow the Chinese US dollar conversion rate. I like to use it for the futures market and also to watch the bond market rates and commodities. So that's a good phone app you can download free. Seeking Alpha, I like to create special stock lists with different categories, and I change those from time to time. Now, again, I'm not trading all these assets, but if you do watch my daily video, there's certain ETFs that can be a canary in the coal mine, like that LQD ETF. If we see that tank, that is a disaster for stocks. That means they can't do their corporate buybacks. Also, what's neat about Seeking Alpha is it will feed you very niche articles about the stocks you're following straight to your app, so that's a useful tool. We recommend the Roku and a little Bluetooth so you can listen to this media with extreme ease. You got to get your Bluetooth headset. I'm digesting at least 5 hours of content a day, usually closer to 10. And then finally, I like to follow Zero Hedge and the Drudge Report in terms of reading articles. Now I handpick the articles. I'm not reading everything. A final recommendation is Bloomberg.com. They have a free newsletter that really does a great job of summing up things, probably from more of a centrist point of view or even a leftist point of view. But these are the newsletters I follow daily. And again, those are free. So that gives you an overview of sort of what information we're looking at, how our strategy may adopt over time, and what our results have been to date. All right, guys, let's open this up for some questions and start popping up some polls here and get some interaction going. Wow, we got a lot of people on. Shout out to some names: John Arrington, Guang King, Elizabeth Davidson. I'm unmuting everybody. Any questions out there?
Yeah, I'm going to go ahead and say, give some more shout outs here, Jason. D. Hillstrom, nice to see you in here. That's the first time I've seen you in here. Welcome. John Arrington, welcome. First time I've seen you in here. Malcolm Waters, welcome in. Thank you for your time. Mr. Mason, welcome in. Thank you for your time. Bunny, thank you very much for joining us. Truly appreciate it. Robert Price, thank you very much for your time. Let's see here. Who else? Okay, and Tom Lauer, thank you all for joining us today. We really appreciate it.
See, we got a lot of background noise. I've popped up a poll if everybody wants to take it. What it says is, what are you doing to protect yourself from a major sell-off in the market today? So far we've had 2 out of 17 vote. If everybody wouldn't mind posting that, we'd love to see your response. And also, if you have any questions, feel free to hit the raise your hand button so I can unmute you, or you can use the chat box. Any questions out there while we're getting the responses back on this first poll?
And real quick, guys, if you scroll to the bottom of your screen, there's a microphone button. Just click on that. That will unmute your microphone. Okay, if you see a red slash through it, that means you're muted. All you have to do is click on it. It'll unmute, and then you can talk with us live here. And if you have a bad audio setup, you can always click on chat and just post the questions in there by typing as well. And you'll find that if you scroll to the bottom of your screen too, it looks like there's a little conversation bubble. Just click on that and just go. Feel free to type in your question. Great presentation, Jason. Thank you, bud.
Oh, thanks, Dean. Let's see what Oscar thinks. I know he came on just for that little piece. Oh, did he hop off? I saw him. I think he just hopped off.
Yeah.
Elizabeth, how's it going? I see you have your mic unmuted. You want to say hello?
What time?
About another 15 minutes.
Okay.
Hey, Ken, how's it going?
Great. Most of my retirement is in gold and silver.
I can't hear you.
No, that's a risky strategy right there. Did you get to see most of our presentation? I like gold, but not 100%, and only during rare time periods is it good. Now, you saw we have a 10% allocation in gold, right?
Yeah.
So I like gold for sure because we have lowering interest rates and a Federal Reserve. But it's a very volatile asset, and the second those two things start to ease, then you see a rapid decline in the spot price of gold. So unless we continue to have lowering interest rates, unless we continue to have fear in the market, it's just not a smart strategy to try to have consistent income. Are you trying to generate consistent income in retirement, or are you trying to hit a home run return and get rich?
That was just a safe place for Trump. I've got some more money that I've used to do options tradings with.
Okay, and Kenneth, do you have physical gold or do you have a gold ETF?
It's physical gold.
Okay, gotcha. Okay, yeah, prices are pretty elevated, and it's also really good to know that the way the financial system works, it will absolutely put a ceiling on the spot price of gold, and we're really darn close to that ceiling right now. So might be a good time to scale out of some of it, honestly, and put some more capital to work with us. How many shares do you have allocated across the portfolio now, Kenneth?
I got 200 shares of the SPY, and
Okay. How many TLT do you have?
100 shares.
Okay, so it should be opposite. You should have double the amount of TLT shares for the number of SPY shares you have. That way you get hedged properly.
Okay.
So guys, this is a strategy that's a lot safer than, I'll tell you right off the bat, I really like gold, and I think there's a high probability. Now, I'd rather own gold miners than spot gold. We played spot gold. The time you want to play spot gold is when you think there's going to be quantitative easing and lowering of interest rates. Okay, so we predicted that and had a nice rally in the gold. And our gold returns are actually bigger than any other returns in our portfolio. But now we're at 1,500 spot. So you got to ask yourself, who really benefits from this elevated price of gold? Well, guess what? The gold miners, who have absolutely been just destroyed over the last 5 years. Think about it. The last big time we had a rally in gold was 2012. They've just been decimated over the past 5 years. Their income statements are terrible. They've been losing so much money. So the prices for the gold mining companies are dirt cheap. So if you really think there's a bull market left in gold, which I do, you're going to make a lot more money being long these beat down gold miners with a lot less risk. In fact, I wouldn't even mind if spot gold sold off to 1,400, because these gold miners are still going to make a hefty profit at these elevated prices. But meanwhile, you got to ask yourself, how high can spot gold really go from here? central banks are loading up on it right now. That's putting somewhat of a ceiling on the value of spot gold. So the better play right now is the gold miners. And so you go look at Stanley Druckenmiller. Guess what he owns? He owns GOLD. Guess what? That's the biggest position in GDX. But what happens if China trade talks make a phase one deal and this impeachment nonsense goes away and the Federal Reserve goes from, you know what, everything's going really good now, we're going to start planning on stopping QE and raising interest rates. Well, guess what? Your gold spot is going to drop like a rock in the middle of the ocean. And the support for it, it won't be there. I highly recommend you don't have a huge gold position going into retirement. 10%. If you go look at any hedge fund manager that's made a name for himself, 10% is a huge allocation. This is a very ballsy play on gold, and I'd only recommend this 10% position if I was highly certain that we have a period of lowering interest rates and quantitative easing. But if we get a phase one deal and this impeachment just kind of blows over as noise, and all of a sudden we get a strong GDP print next year, and the Fed starts saying, well, things look pretty good. We're not lowering rates at all anymore. Watch out, buddy. That gold is going to drop like a rock. So that's why you want to have a portfolio that is not correlated. All of these assets are highly uncorrelated. And when you overlap them and get the big picture correct with monetary policy and inflation, it makes it very hard to have a losing period in your portfolio. And so who cares about what kind of return you could make? At this point in your life, it's all about how do I not lose money? I'll take the easy hanging fruit, but more importantly is I'm not going to lose money. And so this setup right here is much smarter, much safer than just having a huge gold position. And it's very important that you do follow the allocation because, yeah, as Dean pointed out, you have a heavy equity portfolio and a light bond portfolio and an extremely overweight gold portfolio. And so if any good news were to come from the trade deal, the impeachment, or the Federal Reserve deciding it's time to, even if they just stop lowering rates, that might be pretty detrimental to spot gold. So there's a lot of risk in that. And I'd highly recommend considering a safer approach. Now let's see, who else is out there? Elizabeth, do you have your microphone today?
I think she just said she had to run.
Oh, okay. Okay, Malcolm, I see you have your hand raised. Does your microphone work?
I hope so. Can you hear me?
Yes. Where are you dialing in from? You sound British.
I'm England, yeah.
Nice.
Bit cold, but yeah, it's good. Got a question for you. The slide that I'm looking at the moment says trade allocation per $75,000. Target income $750 a month. Well, I make that $9,000 a year.
Correct.
So if I know you've got an offer on at the moment on your fees, but if you take the original annual fee of $5,000 for your services, that's $5,000 fee on a $9,000 income. Can you please comment on that, please?
Well, hopefully you got more than 75,000 to invest. Most of
many
people
people
a lot
don't.
of clients trading this with a million plus, Malcolm. So that is key. Now, let me ask you this: do you have access to ETFs? I've heard that the UK has banned all ETFs. I don't know how you're going to go about it. Maybe with LLC or something of that sort.
I have an account with Saxo Bank, and they, as far as I'm aware, they have access to all the ETFs.
Okay.
Yeah, Jason.
Now, let me point this out, Malcolm. If you have 75K, your broker should give you 2-to-1 buying power. So immediately you could double this.
2-to-1 leverage.
Right. Yeah, you could use 2-to-1 leverage, And again, because of how safe this is, it makes sense to take advantage of any low, we're in a low interest rate world right now. So it makes sense to take that low interest money from your broker and apply it to a very conservative, safe strategy. Now, 3-5 years from now, when all these central banks have no choice but to raise interest rates, you're not going to have the luxury of free credit from your broker dealer. So I would take advantage of that while you can. But yeah, Malcolm, many people, most people following this have at least $500,000. I simply show you this slide so you know how to multiply it based on your account size.
Okay, that's cool. Thank you for explaining that.
And then again, most folks, they start off very timid. They start off with, one set, and then they realize this is so much better than what they're already doing. And typically, my clients will say, all right, I've got 99% of my assets following you, and I have 1% now doing my fun, whatever my fun hobby trades are. And because, it's just not fun to lose money. And after you've been around the block a few times, and everyone on here has, that. It's not fun to worry about your future. It's not fun to worry about your nest egg. And it's not fun to gamble your savings. And so this setup is proven now for the last 11 months to do just that, to especially do well when stocks sell off. And unfortunately, most people I do meet, I found a mix. We've found a whole bunch of random people who just have way too much random gold mining companies. And they're buying the worst ones, the ones that are just pump and dump penny stock scams. They're not buying, there's really like 5 gold companies in the world who have access to capital and can go dig up that barbellic relic while they have time. And I'm telling you, we've got 2 to 3 years max for these gold companies to have their heyday before this period of time is over. So you want to get your cash that is playing the gold market in the companies that can act right now and mine gold, sell it to these central banks, and get it off their books for a profit. Because these gold mining companies, the second these conditions change, have a terrible business model.
Yeah, and Malcolm, one other thing I'll point out as well, bud. We absolutely undersell and overdeliver. That's Jason and I's entire philosophy with this company. Okay.
Uh-huh.
What our members have seen and what I've been able to realize is closer to 1.5% too. So we put the 1% number up there, and it's just $75,000 tranches to think about, right? So that's kind of the minimum to get what Jason calls the atomic bomb proof portfolio balance. I like to call it the Zen balance. Okay, but yeah, you just take that 75 and maybe you have 300K to trade. Scale it up there. That would be four tranches, right? And then with that amount of capital at 1.5% a month average, not bad.
Malcolm, let me ask you this. Where do you have you don't need to tell us how much money you have, okay, but just tell me, where do you have the bulk of your assets placed right now? Are you in cash, equities, bonds? Do you have a mix?
I'm in cash, and I'm in gold, physical gold and silver.
Okay, now what would you say your ratio of cash to gold to precious metals is?
10% gold.
10% gold, 90% cash?
Yeah, I'm not into any equities or none at all. Just cash and gold.
So you're basically just waiting for the reset to jump in, huh?
I don't know what to do. My plan really doesn't have an outcome because there's no growth really in the portfolio. So I'm just working at the moment, pushing all my money into my retirement account.
Cool. Well, let me just leave some comments on your strategy and what I think about that. So first of all, I would salute you to being more intelligent than most, realizing that the stock and bond market is in a bubble and it's highly risky. So just buying and holding those assets is not a great idea right now. But you got to ask yourself, is owning the dollar a smart move right now as well? What do you think is going to happen? I guess you're probably holding the pound, or are you holding the dollar? Or?
I'm holding the pound.
Pound.
Mm-hmm.
Okay, so you got to ask yourself, what is happening in your area? Well, Christine Lagarde's supposed to come in and unload a bazooka of stimulus, I believe. So, what could possibly happen to the value of the dollar or the pound when we have all the central banks expanding the monetary supply? Do you think it's going to make your buying power go up or down?
Down, big style.
Yeah, down. So during a period where they expand the monetary supply, we have to take the risk and own these assets. Okay, so you're going to lose your buying power, and the assets that are not expanding, like stock shares, are going to go up. So your gold play should do very well during this period, but your cash position doesn't do very well at all. Now note, I do have a period of time where I recommend owning plain old dollars, but that's when your rates are high. Think about it. Let's go back to this chart. Here's where we want to have a big cash position. Let me show you. During a period of rising rates, as we get near the top, that's when it's going to really make sense to have cash in the bank. It's going to pay you so much interest. Right now, we're in the opposite of that period. Right now, you're going to lose buying power and watch these assets just go up, up, up until they implode. That's the predicament that central planners have put us in when they run monetary policy the way they do. So unfortunately, we're clearly, it's not even a doubt now. Last year, maybe it was doubtful. In fact, they're telling us the opposite, but this year it's not. We're in a period of buying treasuries, 40 billion over there in the UK a month, and 60 billion here in the US.
Hey, Jason, can you mute TomTom 8005 real quick?
Yeah, Tom, you got a question?
He's just giving a lot of feedback.
Oh, you want me to just mute him?
Yeah, thank you. There you go.
So I would tell you, Malcolm, that you're smart to have cash instead of just being outright long equities or bonds. But you're not smart in that the buying power is going to be a lot less if you just stay in that setup. I like your gold position.
Mm-hmm.
I like your gold position, especially at 10%. You can see that matches to mine exactly. I'd rather see you owning gold miners than spot gold, because spot gold's at very high price, and the central banks are buying it up. So the folks that are going to profit from this are the miners. But the catch is, a lot of people like to go buy these tiny unknown miners who all they're going to do is take your money and go run investment relation ads and then pay themselves a big paycheck. They're not going to mine any gold whatsoever. So there's really just a handful of companies that are situated to do well right now, and GDX does a great job at holding those companies. And then the second thing to track is, are rates going up or down? Well, rates are going down clearly. 80% of all central banks lowered rates this year. Why? Because China's GDP is crashing at an alarming rate, from 14% half a decade ago to 6%, the worst print in 27 years. And it's starting to look like they may actually want to allow their economy to go into a recession to try to win this trade war, because they know if they let things slow down enough, it'll work its way to the US and put a lot of pressure on Donald Trump in his election. So I would definitely recommend you consider our setup right here.
I know a lot of people who, around about my age, that have portfolios between, say, $75,000 and $125,000. The business model that you're offering is a little bit unattractive. The percentage fee, effectively, like if you were paying a fund manager, you wouldn't expect to be paying them like between 25 and 50% fee.
Well, Malcolm, if that's what's holding you back, call Dean, ask him about the lifetime price. We can get you in for a one-time fee and you won't ever pay a penny. A lot of here's what people do. They take the free trial. They see it works. Okay, now what did you notice about how we go about our business compared to every other advisory out there? Have you ever seen an advisor tell you the trades, or an advisory like us tell you the trades, tell you the plan, show you the results with no?
Yeah. There's quite a lot of competition out there for the subscription dollar, if that's what you want to call it.
Right, but how do they go about pitching their product? Do they show you what they do, or do they just hype you up about how much money you're going to make?
No, I only subscribe to the free trials where they actually tell you and go through a live demo. So I've looked at about maybe half a dozen this year. I haven't subscribed to any of them yet because I haven't found anything that matched my expectations in terms of the fee structure. But maybe there will be someday. But you said in the intro that you had 150 subscribers. I guess you could probably 10x that if you had a fee structure that was within the $1,000 to $1,500 per year range, because that kind of makes it more attractive to people who've got $125,000 max portfolios. My wife works in marketing, and that is exactly what she said you need to do. You'll pull them in like reeling fish in off a line if you offered a subscription model that was in that area, because there are so many people.
A discounted one that has the Tuesday, Thursday trade, Malcolm, if you want.
Yeah, I noticed that. Yeah, I don't know what the exact price is of that, but there's a load of people all over the world, but especially here in England, that need a solution to the miserable returns that we get on our capital. And we also recently deregulated our pension system over here. You may have heard about it, where you can now draw out of the previously protected pension funds. You can draw up to 100% of the money out in a single lump sum if you're over 80.
Let me tell you this, Malcolm. If you don't take action and you stay in cash, and we really have 10% inflation right now, which we saw in the previous slide, you're losing $10,000 a year of buying power. Now, let's say you go find some scummy little advisory that costs $1,000 a month or a year. And let's say they put you in a long equity position, and then you lose 30%. Now you've lost almost half your portfolio in the next 24 months. And I ask you, how much did it cost you not to take our advice?
Yeah, that's a fair point. Yeah,
it's currently 10,000 a year. And another
so
thing,
if you stay in cash, you're losing 10 grand a year right now.
Exactly.
Well,
more like 12.5. Anyways, and one more point too, Malcolm, and just something to think about. Okay, not saying you have to do this, but you could definitely start with with the 125. Okay, get comfortable with us, and this is what a lot of people do. They start with close to $100,000 with us. Okay, they see it work for 1 to 3 weeks, and then they say, okay, this is super defensive. This is definitely making a small gain on a weekly basis, okay, on a monthly basis, however you want to look at it, and then they quickly take their 100K, either figure out another way to get another 100K or leverage up, and then month 2 they're trading 200K behind us. They're pulling 1 to 1.5% out of that, and then you fast forward to 4 months later, and we have people that are 4x leveraged to $1 million capital, or we have some of our members that are using over $3 million with the system. And
I guess it's okay to use $3 million.
Let me say this, but the typical client who wants to make 1% a month doesn't have $100,000. So we are, we're a high-end advisory. We're more like the iPhone. We're a lot less like the Samsung or the Huawei. We're not some sort of cheap ripoff. So we're very attractive to very wealthy conservative investors who appreciate capital preservation.
I absolutely understand what you're saying. Yeah, so maybe you need people that have at least $1 million, maybe $2 million before they even consider subscribing with you.
Well, if you have 250,000 and you're averaging 2.5K a month, I'd say that's probably where it starts to really get exciting for our clientele. But
Yeah.
again, I would still argue,
Yeah.
you know, how much are you going to lose doing the wrong strategy?
Or just sitting in cash as you are now. I mean,
Is
might as well just take $12,500 and burn it.
Well, I guess we would have some warning of the crash, and so you could kind of short the markets generally. I guess that's what I would probably do if I saw signs that the Dow was rolling over and the Nasdaq was rolling over and everything was going to hell in a handcart. I'd probably put a big short on the markets with some of my portfolio. That was if I stayed as I am in cash. But obviously, a system like yours would appear to be a really good solution. But my problem is it's just too high a percentage of the total returns. And I don't really want to leverage up because that implies more risk of loss if you know, for whatever losses may come your way. And to be fair, you've only got 11 months track record. You haven't got a full market cycle of results behind you. So there's an element of risk in there too, if you know what I mean.
Sure, absolutely. Let's see what other questions we have out there. Thank you for the questions, Malcolm. And if you have more, please feel free to reach out. Let's see, we got a lot of people
Thanks,
in
guys.
there. Yeah, no, and stay on. We're not done yet at all. So, and I agree, certainly, Malcolm. You know, if it's too expensive for you, it's too expensive for you. A lot of people wait till they lose 5-10 grand and then they call us up. So sometimes you don't go to the doctor till you're sick. So, you know, if that's your personality type, then perhaps you wait till you have a losing period of time and then buy. For other folks, they like to prevent. And I think we've done a great job at proving our track record, our strategy in quite a few circumstances. So we do have a profit during a 20% pullback. That's not an '08 crash, but it's still a 20% crash with 1% gain. In May, I can tell you, I sure as hell didn't see that pullback coming, but we pulled off a 2.2% return. July, I thought the trade war was going to escalate. Completely wrong. We lost 1%, our biggest drawdown. Because of the overlap of the assets, we can be wrong and not get killed. That's what's so important here. August, definitely did not see that coming. Didn't think he was going to raise the tariffs. I thought he was going to wait till after the election. Completely wrong. We got 1.8% return. So what's important is because of the overlap between the stocks and the bonds with the put options right below our assets, and understanding the way the financial system's engineered and understanding the big player that really makes the markets change is the central banks. As long as we can predict their actions, we can stay true to our formula of success and rinse, wash, and repeat. Now, as I've outlined, that big picture view of what the central banks are going to do can change over time, and that will force us to modify the strategy slightly. But we're not talking about big modifications, very small tweaks. As the assets don't change, really it's just going to be the option caller that changes. And so this is where the magic really happens, is having the right allocation. And as you've seen, I just hardly tweak those settings, but then being able to profit from a down move. This is the way you want to profit from a crash in either the bond market or the stock market. You don't want to buy put options. Here's what happens. You go buy a put option and you're wrong by a month or by $1, you're going to lose 50% of whatever you risked. Okay, it's not the smart way to profit from a down move. The smart way is to buy the asset you think's going down and then sell a highly valuable in-the-money call option to finance your put option. This lets me get a hefty bet on the downside for free and safely profit from down moves. And if I'm wrong, I lose $100. If I'm right, I can make $200 each period with this example right here. So this is the magic setup you want during a period of rising rates, a period of quantitative tightening, and a period of inflation, which I'm afraid is probably coming our way sooner than anybody would like. Now, till that happens, we're going to be mostly doing these two setups right here, the tight and the loose, where we're bullish on these assets. We're still in the bubble. We have clear indication that we have lowering rates, quantitative easing, and the inflation is not in sight yet. So you can't just own the dollar. You're going to lose value rapidly as these balance sheets around the world expand. And the debt now has grown significantly in the last decade. So we're talking $266 trillion of sovereign debt spread around the world now, much of which is accredited to China, who may be, by design, trying to pop these bubbles, as we're not seeing them follow suit right now and expand their balance sheet. Just the US and the UK really are. Any other questions out there? I'd love to hear from some of our other members and
Hey,
people
Jason.
interested. Hey, Ron.
This is Ron. I'd just say I've been on with you about a month, and today, pretty down day. I think everybody would agree, but I'm up. So your program's working. That's
Hell
all
yeah,
I have
it
to
is.
say.
Yeah, we had a very good day today because of exactly what we've been talking about. Thanks for sharing that, Ron.
Yeah,
TLT
you try to
paid
get.
off and the put option kicked in.
Yep, you're exactly right.
Now, do you have any questions, Ron? I know you were on
Nope.
Yesterday's webinar too, right?
Oh yeah, no, I don't have any questions.
Nice. Well, that's always good to hear.
Yeah.
Here, Tom Lauer. Any questions for us, bud? Nusani, any questions for us? Mr. Mason? Godwin, do you have any questions for us, guys?
All right, guys. Well, we really appreciate your time. Don't forget, every Thursday, there's a repeat of the webinar. I do change the content as things develop, and you'll get the email every Thursday. You never get cut off the free webinar. Some people will join for months before they join. But do remember, once you do upgrade, you'll be in the Wednesday webinar where we do cover a lot more of the actual engineering of the strategy and talk about the future, how we're going to alter our trades. And we'd love to get you guys joining the program and being part of the full program. So thank you, everybody, for your time. And this replay will go out Saturday, so you can watch it a few times and make sure you're up to date on everything covered. Malcolm, any last questions before we close this out?
No, none from me, thank you.
All right. Well, we really appreciate it, and thank everyone for joining today.
Nusami, did you have a question, bud?
Well, I was just wondering that how come you don't do this on an individual stock?
Oh, okay. So the S&P 500, the SPY, has 504 companies, and that reduces business risk. That's very important for our strategy because we're trying to reduce risk and create safe returns. If I were to just put all your cash into an individual stock, you're now at the whims of that individual company's business risk. So one bad report, one bad lawsuit, hell, it could even be one bad tweet these days. And people abandon ship like you've never seen.
Yeah.
Just look at Fisher, man. He said something sexist, and $3 billion have now flowed out of his fund.
Yeah. Yeah.
The NBA, they critique Hong Kong, and now they're having backlash.
Yeah. Okay. All right. I'm just following you. I mean, I've been getting your thing, but I never seriously looked into it except today. So let me kind of check you out a couple of weeks and then decide. Thank you.
Tell me, what's your portfolio look like right now? You have a handful of stocks? Or?
Yeah, I have about 20, 30 stocks. I go in and out. I'm like a swing trader, day trader, you know. I like to kind of jump on the instant things happening on the market, you know. Like wave.
What's your, let me ask you this. What's your greatest drawdown in the last, let's not even count December. Let's just say this year.
Well, I'm down 17%, to be honest with you. I took a big hit in December, so.
Holy shit. If I lost 17%, here's one thing I would point out. You go trading, okay? You lose some money. You know, probably your worst thing that's going to happen is you might tell your wife. Maybe you don't tell your wife, but no one's really watching, right? If I lose even 1%, all hell breaks loose because our clients are so used to consistent returns with low drawdown.
Yeah.
So that's one thing is you've got to realize every time I think, oh, that looks like a juicy trade. Oh, man, that looks like a good one. I got to ask myself, is it really worth risking my reputation and my track record on that trade? And usually the answer is no.
Mm-hmm.
And so there's a great deal of pressure for me to perform and keep these numbers up.
Okay.
So yeah, losing 17% would be unbelievable for our strategy. In fact, our biggest drawdown was 1% so far.
Right. I heard in your thing, yeah.
Now, do you have at least $100,000 to put to work to make this worthwhile for you, or?
Yeah.
Okay.
With my 401k and all that, I have about, $500,000.
So look, you could be smooth sailing, slowly growing your portfolio, very little risk, or and trading 5 minutes a day max. Here's what I want to do if you join my program. I want to replace all this time you're spending swing trading or day trading or whatever the hell it is.
Mm-hmm.
Let's replace it with some quality education. So you'll make more money with less work, and instead of sitting there losing money trying to predict markets, it's a random walk. It's very hard to do. I'll give you plenty of education to study to keep you busy so that you don't feel like you need to be cranking out these crazy trades, trying to play earnings and look at technical setups or whatever it is.
Mm-hmm.
Yeah, with our program, you'll spend no more than 5 minutes a day max. In fact, probably more like 2.
Okay. All right. Like I said, I've been getting your texts and I never quite paid attention to it, except today I listened to you for the first time. So let me kind of check you out in a couple of weeks and then see if there's something that I would like to do.
Sure.
Okay.
Cool. Yeah.
All right. Thank you, sir.
Absolutely, Nusami. And so you're a similar account size with what I'm working with as well. But yeah, at 500K, you should be making about $7,500 a month on average with us. So service fee would be less than 1%. There's not a money manager on the planet that's going to give you that.
Okay.
So it'd be less than 1% management fee, right? But yeah, and definitely save my number too, Nusami. Feel free to ask me any questions, and really the best way to test it, and see the results is you can either paper trade it, okay? That's like using monopoly money, but you see exactly what we would have returned. Let's say, you put in 500K to the account, follow it for 2 weeks, see how much money you made. I would say probably 25%, maybe 30% of our customers have actually made the cost of our fee, our annual fee, before they even start the trial too.
So when you say annual fee, you manage the money or just for your subscription?
No, so we just have a subscription cost. You have 100% control of your money at all times.
Okay.
Jason and I are going to engineer the trades and put them out to you. Okay.
Mm-hmm.
All you have to do is take 30 seconds to replicate it with your brokerage account. Okay. It takes me about 10 minutes a month total to replicate the trades.
Mm-hmm.
Okay. Now, obviously, you can get more involved if you want. You can spend more time, coming to our webinars and, filling out what we do and why.
Mm-hmm.
But as far as replicating the results, I mean that's literally 10 minutes a month for me.
Okay.
And I
So
mean,
do you,
10,
I'm
if you're
sorry,
10,
go ahead.
yeah, if you think of, I mean, if you're 10 minutes a month to make $7,500 on average, yeah, that's not bad.
Yeah. So do you have a trial period, and what's the cost of the subscription?
Yeah, so we do have a 2-week trial period, okay, and I don't know if you've started that or not. We can definitely check on that. Call me after the webinar,
Okay.
Nusami. We'll check that out,
All right,
okay.
sir.
And our annual fee is 4,997, but we actually do have a 40% discount on that today.
Okay. All right.
Okay.
Okay,
But
sir.
yeah, save my number, Nusami, and give me a call after. Okay.
All right. You have a nice one, sir. Thank you.
Okay. You too, bud. Thank you for your time.
Any last questions out there before we wrap up today's webinar? Going once, going twice. Sold. Okay, thank you guys for joining us live. We really appreciate it. Tomorrow we'll be closing out our SPY trade. And then keep in mind, next Thursday, there's another free webinar and the same schedule. So Monday, Wednesday, Friday, we trade the SPY at noon Eastern. Tuesday, we play emerging markets currently. And then Thursday, the bond market. This overlay makes it very hard to lose capital and protects your assets while generating consistent returns.